Ever wondered why billionaires like Jeff Bezos and Warren Buffett sell their stocks? Perhaps you suppose they know something that we don't. Well, you're about to find out. Today, we're diving into the world of high-stakes finance, where every move is calculated and every decision could mean billions. We'll explore the strategies of these financial giants, uncover their reasons for selling off large portions of their stock, and reveal what this could mean for the rest of us. So, don't go anywhere. Stay tuned as we unravel the reasons behind these billion-dollar stock sales. Let's start with Jeff Bezos, the brains behind Amazon. In 2024, he made a deal selling a whopping $3.1 billion of his Amazon shares. But you might wonder, why? It's not because he no longer believes in the very company he built from scratch. Quite the opposite. Jeff Bezos, in line with other corporate bigwigs, employs the SEC Rule 10b-51 trading plan to guide his stock sales. Confused about what this rule implies? Let me simplify it for you. Essentially, this rule empowers company insiders to chalk out a trading plan, scheduling stock sales of predetermined numbers of shares on specific future dates. An ingenious strategy, don't you think? And why so? It allows personalities like Bezos to gradually sell shares without the risk of being indicted for insider trading. Insider trading is a grave offense committed when insiders of a company trade stocks based on non-public, crucial information. By pre-planning his stock sales, Bezos ensures that his trades aren't swayed by any significant news events that the public isn't aware of yet. Therefore, when Bezos cashed in $3.1 billion in Amazon stock, it wasn't an impromptu decision, it was the execution of a premeditated plan, a strategic move that had been brewing for a while. Even after these sales, he still had a considerable chunk of Amazon stock. These sales form a routine part of his financial strategy, giving him the chance to diversify his investments and not put all his eggs in one basket, if you get my drift. So, Bezos' stock sale wasn't a sign of waning faith in Amazon, but rather, a part of standard financial strategy. It's a chess game, not a simple game of checkers, and Bezos is indeed playing it with finesse. Now, isn't that an intriguing insight? If you found this interesting and would like to dive deeper into the world of finance and corporate strategies, make sure to leave your thoughts in the comments below. If you enjoyed this content, don't forget to show some love with a like and a share. And for more such enlightening content, hit the subscribe button. Let's continue this journey of discovery together. Moving on to Warren Buffett, the Oracle of Omaha. He sold a whopping $8 billion worth of stock in the second quarter of 2024. But what's the reason behind this? Well, it's all about the long game. See, Buffett, known for his long-term investment strategy, isn't one to make hasty decisions. His firm, Berkshire Hathaway, sold a staggering $13.3 billion in stocks in the first quarter, followed by the $8 billion in the second quarter. These aren't just random sales. Buffett is a master strategist, so what's he playing at? Some financial experts and economists believe he might be increasing his company's cash reserves in anticipation of economic changes. Now, this doesn't necessarily mean he's pessimistic about the economy, rather, it indicates he's staying prepared. Think of it like this. Imagine you're on a roller coaster. You know there are going to be dips and rises, but you don't know when. If you're prepared, those dips won't be as scary. In fact, they could be exciting opportunities. That's how Buffett sees the economy. He knows there will be downturns, but instead of panicking, he sees them as opportunities to buy stock at lower prices. And why is that? Because when the market dips, stocks are essentially on sale. It's like Black Friday for investors. If you have the cash on hand, you can buy more shares for less money. Then, when the market recovers, those shares could potentially be worth much more. But remember, this isn't a strategy for the faint-hearted or the impatient. It requires careful planning, strategic thinking, and most importantly, time. Buffett is not looking for quick returns, he's looking for solid investments that will grow over the long term. So, what can we take away from this? Well, like Buffett, it's important to have a game plan. Understand the market, anticipate changes, and be ready to act when opportunity knocks. And most importantly, remember that investing is not a sprint, it's a marathon. Buffett's moves are a strategic play, possibly preparing for economic downturns. So whether you're a seasoned investor or just starting out, there's a lot to learn from the Oracle of Omaha. Now that we know why Bezos and Buffett sold their stocks, what can we learn from their strategies? These billionaires, whose names have become synonymous with financial success, are not playing a game of chance. Instead, they are employing well-thought-out strategies, reflecting their personal financial strategies and the broader economic trends. Let's unpack this a bit further. Jeff Bezos, the founder of Amazon, sold a whopping $3.1 billion worth of Amazon stock. But this wasn't a spur-of-the-moment decision. It was part of a prearranged 10b5-1 trading plan. This strategy allows company insiders like Bezos to set up scheduled stock sales without risking accusations of insider trading. So, even though Bezos sold a significant portion of his shares, it was a planned move, not a hasty reaction to market changes. And despite these sales, he still owns a substantial portion of Amazon stock, which tells us that these sales are a routine part of his financial strategy. Now let's shift our focus to Warren Buffett. Known for his long-term investment strategy, Buffett, through his firm, Berkshire Hathaway, sold $8 billion worth of stock in the second quarter. This followed a sale of a staggering $13.3 billion worth of stocks in the first quarter. These sales aren't random, they're strategic. Some experts speculate that Buffett might be increasing his company's cash reserves in anticipation of economic changes. In fact, he might be preparing to buy stock when the market dips, capitalizing on lower prices during economic downturns. So what's the takeaway here? Both Bezos and Buffett's actions reveal a strategic approach to managing their vast investment portfolios. They take into account both their personal financial strategies and broader economic trends. They are not reactive but proactive, planning their moves long ahead and adjusting their strategies based on their predictions of the economic climate. As we see, these billionaires are not just selling their stocks randomly, but rather, they are making calculated strategic moves. So, what can we, as investors, learn from these billionaires' stock sales? Well, first, it's clear that investing isn't a game of chance. It's a strategic endeavor that requires careful planning and consideration. Both Bezos and Buffett didn't wake up one day and decide to sell their stocks on a whim. They had a plan, a strategy. This teaches us the importance of having a game plan when it comes to investing. And this plan should be based on thorough research, careful consideration of market trends, and most importantly, your own financial goals and risk tolerance. Second, we see the value of diversification in their actions. Even though these billionaires have made their fortunes in specific industries, they don't put all their eggs in one basket. Bezos, for instance, still owns a considerable portion of Amazon stock, but he's also diversified his portfolio. This is a lesson for us all. Don't tie your fortunes to the fate of a single stock. Diversify your investments to spread the risk and increase the potential for returns. Lastly, there's the lesson of being prepared for economic changes. Buffett's sale of stocks may seem alarming at first glance, but when we understand that he might be increasing his cash reserves in anticipation of potential economic downturns, it paints a different picture. It's a reminder that the economy is ever-changing. And as investors, we should always be prepared for these changes. It's not about timing the market, but about being ready to seize opportunities when they present themselves. So what's the key takeaway here? Investing isn't just about buying low and selling high, it's about having a strategic approach, diversifying your portfolio, and being prepared for economic changes. It's about understanding the market and making informed decisions based on that understanding. Remember, investing is not about following the crowd, but about making informed and strategic decisions. So next time you hear about a billionaire selling their stocks, don't panic, but rather, try to understand their strategy.